My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. People, my friends, I'm just trying to make you a little money. My job is not just to entertain, but to explain what's going on. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We've got these unexpected tailwinds appearing in the market, and they're keeping the bullish backdrop alive in the face of mounting skepticism. The tailwinds are frankly extraordinary and very much against the grain. One reason for today's bullish action, Dow advanced 202 points, S&P gained 0.88%, and the Nasdaq jumped 1.35%. Let's go over the unusually positive developments that are playing havoc with the bears right now. Even as long-term interest rates keep creeping up higher and Wall Street's waking up to the fact, the reality, I guess, that we won't get 6 rate cuts from the Fed this year. First, this morning, we got a fabulously contrarian analyst recommendation to buy the stock of one of the most hated in the market, Apple. Now, one of my biggest grievances with Wall Street is that analysts love to move as a herd. When a company does well, we see a host of upgrades and price target bumps. When a company does poorly, it's the same group rushes to downgrade. What's the value proposition from the fourth analyst to downgrade Morgan Stanley if that distinctly suboptimal forecast? Simply, what's the value add from one more firm raising its price target on NVIDIA? We get these constantly as the stock keeps blowing through the price targets. Just a bunch of analysts jumping on the bandwagon long after the stock blasted off from the mid-400 level where it's been stuck for so long. Which brings me to Apple. We've seen analyst after analyst downgrade this one on near-term concerns about iPhone sales, especially in China, where the economy has slowed dramatically. Apple's discounting to sell phones there, and the government's not exactly pro-business either. Then out of nowhere, in this desert of negativity, this morning, we found an oasis in a highly unlikely place, Bank of America's Equity Research Department, which upgraded the stock of Apple from hold to buy. I cannot emphasize how important this upgrade was. The analyst who authored it, Wamsi Mohan, is someone who's been a true student of Apple. He's often the person with the most cerebral, thoughtful questions on the quarterly conference call. More important, he hasn't been crazy about the stock in a while. It's kind of out-of-character upgrade. That's the best kind. No wonder the stock rallied $5.95 or 3.2%. By the way, that was the best gain since May. So what's driving the upgrade? He's got 8 points, I think, all worth going over. First, he sees a stronger multi-year, not month, not day, but year iPhone upgrade cycle, driven by the latest hardware to enable generative AI. How refreshing is it that Wamsi's not focused on just the next 3 weeks, he's focused on the next 3 years? Second, he sees higher growth in services, the service revenue, something I've been screaming from the rooftops for ages, because there are fees that must be paid if you want to save your pictures and get Apple Plus or any other extremely worthwhile subscriptions. Third, he sees a silicon roadmap for Apple to morph from PC to services to autonomous driving, which translates into higher margins. Fourth, strong capital returns, including bountiful dividends and buybacks. Fifth, gross margins stable to higher over time. People don't think that one. That's controversial. Sixth, he says Apple's surprisingly underweighted by portfolio managers versus the S&P 500, and the anticipation of AI features could entice institutional investors to increase positions. Seventh, legal issues, manageable. And eighth, the stock's relative underperformance suggests the risks everybody frets about, well, they're already baked into the stock. Now, I notice some of you, this seems like kind of a usual litany, but in each case, it's actually a breath of fresh air. I salute Wamsi for this total go against the grain upgrade that could send the stock up nearly $6 today. This was truly amazing. Second unexpected tailwind for the stock market. We got a nascent theme going here no one's talking about. It's called the return of Japan. Yes, the return of Japan is a force in M&A, which makes me feel like we're back in the 80s, late 80s. Yet there's been a remarkable run in the Japanese stock market of late, almost the polar opposite, by the way, of the Chinese stock market. After spending years lost in the wilderness, the Nikkei is just a spitting distance from where it peaked in 1989. 35,466 now versus a high of 38,957 then. Now, most might not remember this, but Japan was so big back in 1990 that its stock market accounted for 60% of the entire world's stock market capitalization. Back then, you had a series of very high-profile mergers. Bridgestone, the Japanese tire company, it bought Firestone, an iconic company in this country. Bank of Tokyo acquired Union Bank of California. Sony buying Columbia Pictures. Mitsubishi Estate buying the Rockefeller Group, owner of Rockefeller Center. Mitsubishi scooping up a high-profile chemical company, at that time at least, called Aristech Chemical. And Matsushita Electrical, the company buying the Panasonic brand, acquired MCA, owner of Universal Pictures. It got to the point where some leaders in Congress were actually calling for a takeover ban because they thought Japan was becoming too powerful in this country. Then the bubble burst. The Japanese economy spent the next 30-odd years in purgatory. Now Japan's back. Really back. Just no one's talking about it. This morning, Sekisui House bought MDC Holdings for $4.9 billion to become the fifth largest home builder in the world, paying a 19% premium to where the stock went out yesterday. This one shocked me. We haven't seen much home builder consolidation in years. This could be hugely important for the industry. Looking back a month ago, Nippon Steel swooped in to buy U.S. Steel for $55 a share. That was a 40% premium to where the stock was 3 days before the announcement. Jeez, these guys overpay. Well, they pay. I shouldn't say overpay, but I did. I think the people still aren't seeing this trend. I don't know anyone talking about it. It's in its infancy. But as the Nikkei climbs, I expect to see many, many more deals. It's a great reason to stay in the stocks, particularly of mid-cap stocks, as I think that's the sweet spot of interest for them. Third, unexpected tailwind. I know that for some, Disney stock seems like a hopeless and hapless situation. Sneezy, grumpy, whatever. Don't I know it? We own this one for the Charitable Trust, and I am very tired of defending its terrible performance. But so is change agent Nelson Peltz, the billionaire activist investor from Trian, who wants to be on Disney's board and is launching a proxy fight to get in that boardroom. Peltz is running with a guy named Jay Rasulo. He's a former Disney CFO. While his firm would have a little chance to get on the board alone, Peltz is also steward of the 30 million shares owned by Ike Perlmutter, who sold Marvel to Disney for $4 billion 15 years ago. Why does this matter? Because a proxy fight will concentrate the minds of Disney's directors. Either they create more value or try to at least help, or some of them get the boot. I mean, these guys do act as if they are in the playoffs going deep when they ain't even in the second division. Finally, one of the best calls we've ever made for the Charitable Trust was taking a sizable position in Meta. When founder and CEO Mark Zuckerberg announced the year of efficiency, that was a clarion call to get on board because the company had way too many employees. It worked. Now we're seeing a similar, albeit less strident, set of firings from all reaches at Alphabet. The stock's inexpensive. The company could be much more profitable now that they're finally right-sizing things or saying that AI is helping them right-size things. I really don't care. If you apply Zuckerberg's chainsaw playbook to Alphabet, the stock could have a very big run from here. Alphabet's year of efficiency. I bring these items to your attention because I want you to get away from the big obsession that we have here with the Federal Reserve that's captivated so many money managers in a way that's just plain stupid. The idea that I like to use words like stupid because you understand it. The idea that you should only care about how many rate cuts we get this year is an absurd way to run your own money. I'd rather look for these unexpected tailwinds that affect individual companies. It's much more helpful than playing the pedestrian parlor game of guessing the Fed's next cut or increase. Don't be a hedge fund manager, people. Making moves every day to justify our existence. Unlike them, you don't have investors to keep happy other than yourself. Don't let ads scare you out of single stock risk, frighten you. I hate this stuff. Do we really need to own Intel and Wolfspeed to protect ourselves from NVIDIA? I don't think so. Bottom line, invest, don't trade. That's the real edge you have as an individual investor. Don't squander it. Consider yourself lucky that you don't have investors looking over your shoulder and constantly second-guessing you. With the right amount of patient homework, I'm telling you, you will do just fine. Why don't we start with Al in Nevada? Al.
Hello, Mr. Cramer. I'm a first-time caller and a founding member in the investment club.
Yes. Good to have you on board, man. We got a lot of stuff cooking.
My question is about Pfizer. I have a cost basis of $35, and it's close to being a full position in my portfolio. Considering the almost 6% dividend, along with a multi-year time horizon, do you think I should buy more?
I want you to buy more. I think the CGen acquisition is real. I got to get back with Dr. Borla. I'm telling you, the guy's a real guy. Now, I'm not kidding. He's a real guy. He has a real sensibility. I say that because he's a vet. And we're like real animal people. But in reality, he bought CGen. I know he paid a lot of money, but they got a lot of new cancer stuff, and I think it's good to go. Let's go to Ann. Now you know my whole dating calendar, too. I throw everything at everybody. What the heck? No one, by the way, no one ever goes out with anybody on TV. You ever hear that? No one ever says, I want my wife out with these, but they don't do that. That's not allowed. I take it all back. Let's go to Ann in Indiana. Ann.
Hey, Jim. Thanks for taking my call. I'm a club member, but I'm calling about Walgreens because I love the turnaround stories, even though they take patience. So I get a bunch of anecdotal evidence from a friend, who had a long career at Walgreens. Yeah. But then I look at how CVS has struggled, since merging or acquiring Cigna in 2018. So is it a value trap or value stock?
We struggle over this. Both Jeff Marks and I talking about perhaps adding into the bullpen upcoming investment club meeting. Our problem is this, and this is really interesting and important. We screwed up on Foot Locker. We felt that the initial redo and the change in pace would stabilize the stock, and then it just got hammered again. Will Walgreens get hammered again? I don't know. Tim Wentworth is a real deal, but at 22, I'm so tempted to pull the trigger. I just don't know what to do myself. I just don't know. Why don't we go to Blair? I hate to just punt, but you know what? That's better than a lot of guys I saw in the Eagles. Let's go to Blair in Pennsylvania, please. Blair.
Big booyah to you, Jimbo, from Northeast Philly. Been there my whole life.
Really? I got most of my mom's side is over there. What, you like GW in Northeast? Which schools? Oxford Circle there.
Lincoln High School.
Lincoln. Oh, so a little up. All right, doing better than us. That's okay. I don't mind that. What's going on?
Tell me about Palo Alto Networks. Bought it at the all-time high.
What do you need to know about Palo? First of all, we got a billionaire CEO, Nikesh Arora, who's running circles around everybody other than CrowdStrike. And that company, look, can the stock go down? Yes. But is that company in this? Remember, they have like 47 billion different hacks every day at JP Morgan. Remember, they only have to get through one. JP Morgan's got to stop everyone. That's why you need a company like Palo Alto Networks. All right. Individual investors have a real edge in this market. You should consider yourself lucky you're not being second guessed by some rich billionaire right behind you. The billionaire class, let them be on their own and complain about everything. With the right amount of homework, the stock pickers out there will do just fine. Mad Money tonight. Could Fido help make you a fortune? No, I'm not talking about Fidelity. I'm talking about actual animals. I'm seeing if Elanco Animal Health could be a strong contender in the phenomenal pet care space with the company CEO. Then close viewers know I had a bullish thesis on the pipeline space in November. And with Kinder Morgan, one of the largest energy infrastructure companies in North America, reporting earnings last night, I'm running through the report to see if the stock fits into my thesis. And investors have been keeping an eye on the developments of the Red Sea with a number of commercial shipping vessels under attack by the Houthis. How do you interpret these headlines so it can help your portfolio? I'm going to run through all of it and let you know. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.